Okay, hi there, everybody. I am doing this recorded lecture for Chapter 12 of our Principles of Accounting textbook. As we're going to see with the PowerPoint slides, Chapter 12 is revisiting some of the issues or accounting concepts that we've covered before in previous chapters. Mostly like Chapter 4, Chapter 5, where we're looking at this worksheet, but now we're going to take it one step further. I really can't even say one step further because we're preparing the financial statements. We've done that together before, but now we're looking at the financial statements for a merchandising business, both periodic inventory system, perpetual inventory system. So that's kind of the difference in the financial statements that we're going to be preparing, and then also the difference in the closing entries. We've done financial statements before, we've done closing entries before, we've done the worksheet before, but again, we're looking at it from the perspective of a merchandising business that has either periodic inventory or perpetual inventory. So that's what we're looking at in Chapter 12. I'm going to share my screen with you, get the PowerPoints pulled up so we can go over these together. Okay, so Chapter 12, again, we're looking at preparing the financial statements, doing the closing entries, and then it also talks to us about reversing entries that are optional. If we remember that accounting cycle, remember step 10, optional reversing entries, more on an as needed, if necessary type basis, right? So learning objectives of this chapter: prepare a classified income statement for a merchandising firm, prepare a classified balance sheet for any type of business, compute working capital and current ratio, record the closing entries for a merchandising firm, determine which adjusting entries can be reversed, and record the reversing entries. Okay, so this first slide, and I'm going to blow up on this a little bit. This is just showing us, and again, here we're looking, here's the, how do I turn this thing on here? Here's the periodic inventory system. Why isn't it not working here? Hot dog. Uh-oh, let me go back real quick. Let's see, here's the periodic inventory system, right? Here's the perpetual inventory system. And so these are all of the asset, liability, and owner equity accounts. And if you can see, these are exactly the same, whether it's periodic, nice, periodic or perpetual inventory, right? These accounts are exactly the same. All the asset accounts are the same. All the liability accounts are the same. All the equity accounts are the same. The difference is when we get to the next section, revenue, cost of goods sold, expenses, right? So again, we've got periodic here, we've got perpetual here. And so again, we see with revenue, exactly the same. The difference is here, right? In the cost of goods sold section. And so the cost of goods sold section, we remember with periodic, we've got that purchases account. Then we also use purchase returns and allowances. We also use purchase discounts. We also use freight in. On the perpetual side, we only use cost of goods sold, right? So remember, on the perpetual side, purchases are recorded in merchandise inventory as a debit to merchandise inventory. Purchase returns and allowances are recorded as a credit to merchandise inventory. Purchase discounts recorded as a credit to merchandise inventory. Freight in, debit to merchandise inventory, right? So, we're recording these things in the perpetual system, but we use merchandise inventory instead, right? So in periodic system, or perpetual system, we use merchandise inventory to record all of these things. Right, so we've seen that before, and again, we're going to see that and get some more practice with it. Okay, so the income statement. So in the past, when we've prepared our income statement, you know, we've basically said, you know, revenue minus expenses equals net income, right? That's what we said in the past. That's the formula we used in the past, right? Revenues minus expenses equals net income. This is considered a single step income statement, right? That single step income statement, revenues minus expenses equals net income. And also with this single step income statement is that we are not dividing up different revenue accounts. We're not dividing up different expense accounts. We're listing them all together, right? So all revenue accounts in the revenue section, all expense accounts in the expense section, right? We're not categorizing or dividing anything up. With this multi-step now, and that's what we're looking at here, multi-step income statement. We've got a couple more steps because we're going to take net sales minus cost of goods sold. That's going to give us gross profit. And then we take gross profit minus operating expenses. Operating expenses are like the selling, general, and administrative expenses. To get then income from operations. Another, you know, we could also call this AKA net profit, right? So when we think about gross profit versus net profit, right? Gross profit is before we subtract out any operating expenses. Net profit is after we subtract out operating expenses. We also call that income from operations. Okay, so gross profit, and I just mentioned this a moment ago on the previous slide, gross profit and net profit. So gross profit is profit on the sale of, and it's using this example from your book, profit on the sale of a table before any operating expenses have been deducted. Net income or net profit, final or clear profit after all operating expenses have been deducted, right? So this is before operating expenses have been deducted, right? And net income or net profit is after all operating expenses have been deducted. Net profit, final outcome in single sale situations. So here's an example of that. It says Della Reyes bought an antique table at a secondhand store for $800. She sold the table for $1,850. She advertised in the daily newspaper at a cost of $73. How much did she clear as profit? So we'll see, here's the sales revenue, right? Sale of the table, AKA the revenue, $1,850, minus cost of goods sold, the cost of the table, $800, gives us then gross profit of $1,050. And then we have to subtract out the advertising expense, or what we would also call operating expense. And in fact, if we wanted to even be more specific, we would call that operating or selling expense. And advertising expense is considered, it is considered an operating expense, but it falls in the selling category. So then we subtract that out. We've got net income or net profit of $977 on the table. All right, so here's an example of this multi-step, or at least the top half of the multi-step income statement. Here's our net sales, right? And so I mentioned net sales before. Basically, we take, here's our total sales, and then we subtract any sales returns and allowances, any sales discounts to arrive then at net sales, right? And then we know that this is a periodic inventory system. because we see the purchases, purchase discounts, freight in, right? We see purchase returns and allowances. So we know this is the periodic inventory system, this company, Whitewater Raft Supply. This is an example of if they use the periodic inventory system. So for cost of goods sold, we're taking beginning inventory, 67,000. And then we're going to add net or delivered cost of purchases, right? We're going to take that 67,000. We're going to add this 87,920. That's our delivered cost of purchases because again, and we talked about this in chapter 11 a bit. We take our purchases, 87,840. We subtract purchase returns and allowances. We subtract purchase discounts. That gets us to net purchases. And then we add freight in to get to the delivered cost of purchases or the final cost of the purchases. And so we're taking 67,000 plus 87,920. So cost of goods available for sale, 154,920, right? Because this was our beginning inventory up here, right? That was our beginning inventory. Plus the delivered cost of purchases. We had total cost of goods available for sale, 154,920. And then we just subtract out what we didn't sell. We subtract out ending inventory to get cost of goods sold, right? So we take net sales minus cost of goods sold, and that gives us gross profit. And that's what they're showing you here, right? So here's our net sales minus cost of goods sold equals gross profit. All right, here is the second half of the income statement. Remember, once we have gross profit calculated, then we want to subtract any expenses. And so we see all the expenses laid out here. Wage expense, supplies expense, insurance expense, depreciation expense, property tax expense. And so we subtract out those expenses, we get income from operations. And then after income from operations, if applicable, we would list any other revenues or gains. And that's another way. I know it says other income, but we actually call this other revenue or gains. Right? And it says other expenses here. We call this other expenses or losses. And so what goes in the other income slash revenue or other expenses slash losses are things, peripheral transactions that have taken place, not in the normal course of business, but like, for example, we earn interest on an investment. Or on a note receivable, something like that, right? Or other expenses, maybe we sell equipment and incur a loss on the sale of the equipment. Or we sell the equipment and we have a gain on the sale of equipment, right? So, when we think about income from operations, that's income from just our normal business operations, day to day, what we do as a business, right? Where other income, other expenses, this is from kind of what are called side transactions or peripheral, which I'm sure I'm not spelling right, peripheral transactions, like kind of side transactions, not in the normal course of business. So we take income from operations and then we add any, in this case, because we had total other income minus the expense, we add the total other income to arrive then at net income. Okay. Okay, revenue from sales. So, we've mentioned this before. We've looked at this before. Sales returns and allowances and sales discounts are deducted from sales to arrive at net sales. Record these items in the same order in which they appear in the ledger. And so you see, this is our total sales, right? Total. And then we subtract sales and returns and allowances. We subtract sales discounts. We're going to subtract 2920. So then that gets us to net sales of 254,260. Okay, cost of goods sold. Here's that formula there for cost of goods sold. We looked at this on the income statement, but it's showing it to us here again. Remember, we're taking beginning inventory plus the delivered cost of purchases, and that gives us cost of goods available for sale. And then we're going to subtract ending inventory, what we didn't sell, to then get cost of goods sold. Okay. Delivered cost of purchases, it says here, deduct the sum of purchase returns and allowances and purchase discounts from purchases to arrive at net purchases. Add freight into net purchases to get delivered cost of purchases. So we see that here. This would be our total purchases. Oh, if I could write here. Total purchases. And then we subtract purchase returns and allowances. We subtract purchase discounts. So we're going to subtract 2280. So that gets us to net purchases 85,560. And then we have to add freight in. We got to add that. And that gets us to the delivered cost of purchases. All right, operating expenses. So I mentioned earlier, selling, general. General are also called administrative expenses. Administrative expenses. Right, so selling, general, and administrative expenses. So selling expenses, any expenses directly connected with selling activity. So selling expenses, advertising expense, sales salaries, sales commissions, for example, right? Just to name a few. General expenses, this would be like, rent expense, supplies expense, office salaries expense, right? Just to name a few. So selling expenses have to do, again, connected to the selling activity. General expenses or administrative expenses, any expenses related to the office or administration, or any expense that cannot be directly connected with the selling activity. All right, so here's a more inclusive list. So again, selling expenses, sales salary expense, sales commission expense, advertising expense, store supplies expense, delivery expense, depreciation expense on the store equipment, and then general expenses, office salary and property tax expense, depreciation expense, rent expense, insurance expense, office supplies expense, miscellaneous general expense. Okay, other income and other expenses. We talked about this looking at that multi-step income statement a few slides ago, but like it's showing here, other income, which is also known as other revenue / gains, includes any revenue account other than sales. Typical accounts include rent income, interest income, gain on disposal of property and equipment, and miscellaneous income, right? So rent income, interest income, gain on disposal of property or equipment, miscellaneous income. So a side transaction, not part of normal course of business. So peripheral transaction is kind of that technical term for it. And then other expense, remember this is called other expenses / losses. Records various non-operating expenses such as interest expense, loss on disposal of property and equipment. Again, not part of the normal course of business, peripheral transaction. That's what these are called. Peripheral, which I probably didn't spell right, but peripheral transaction. Actions. Okay, so looking at this example, it says use the following information, prepare the cost of goods sold section of an income statement. So again, we'd list the beginning merchandise inventory first, right? This is our first number that we have up here. And then we need our total purchases. That's our second number that we have here. Then we're going to subtract purchase returns and allowances. We're going to subtract purchase discounts. So that's number 3, number 4 here, right? Number 3, number 4. That gets us to net purchases. And then we're going to add freight in. So that's number 5. That gets us to that delivered cost of purchases, right? And so we take our beginning inventory, number 1, plus delivered cost of purchases, that equals cost of goods available for sale. And then we're going to subtract out the ending inventory, basically what we didn't sell, right? That's this number up here. That gets us to that cost of goods sold. Okay, the statement of owner's equity. This one should look familiar to you as well. I know we've gotten practice with this before. It says every figure in the balance sheet columns of the worksheet is used in the statement of owner's equity or the balance sheet. While preparing financial statements, first prepare the income statement, right? That's number 1. We know that. We got to do the income statement first. Then the statement of owner's equity, that's the second one. And then the balance sheet, right? That's the third. It says, while preparing the statement of owner's equity, look in the ledger for the owner's capital account to find any changes made during the year. So here's an example of that. Here's our beginning balance. In this case, the owner made an additional investment. So we add the additional investment, we add net income, and that is the increase for the year. And then we subtract owner withdrawals, and that increase minus the withdrawals gives us the net increase in capital. So we take that beginning balance plus the increase to arrive at now our ending balance. All right. So not too different than what we've seen before. And then here's the top section of the balance sheet. Remember, with the balance sheet, it's prepared using that basic accounting equation. So assets equals liabilities plus equity. So they're showing us just the asset section first. And so we're going to list all of our current assets. Remember, current assets are assets that are expected to be converted to cash or used up within the operating cycle. And generally speaking, these are listed in order of liquidity. Liquidity being how quickly they can be converted to cash, right? So cash is obviously the most liquid asset. And then the rest of them listed in order of liquidity. So how quickly they can be converted to cash. And so that gives us our total current assets. And then we list our fixed assets. That's property, plant, and equipment. We call those fixed assets, AKA plant assets are another name for these, or just simply PPE, which is property, plant, and equipment. And so we've got land. Land is not depreciable. So whatever we purchase the land for, that's what it'll be on our books at forever until we sell it, basically, with a couple exceptions. But land is not depreciable. Building, however, you see the corresponding accumulated depreciation account. Equipment, you see the corresponding accumulated depreciation account. Remember, the difference between these two is what we use for our book value. So this is considered the book value of this building asset, right? The initial cost of the asset was $129,000, less accumulated depreciation. We've got a $74,500 book value. Same thing with this equipment. Beginning cost $33,100 minus accumulated depreciation. We've got a book value of 11,800 book value. And those are the numbers. The book values is what we use in our calculation. So if we add together land plus the book value of the building plus the book value of the equipment, that gives us total property, plant, and equipment. And then we're taking our current assets plus our plant assets to get there then to our total assets. And again, like we know on our balance sheet, liabilities and equity should each also equal $331 and $331,755. And so you see here $331,755, right? Current liabilities, again, listed in the order that we think they'll be paid off. Listed in order to be paid off. Some liabilities have a current portion and a long-term portion. And we see that here with mortgage payable. We see mortgage payable in the current section. This would be what was due within 1 year. Due within 1 year. Let me make that a little bit more specific here, right? The current portion due within 1 year. And then the long-term portion is what is due after a year, basically, right? It'll take longer than a year to pay it off. Okay, so we add together our total liabilities plus total equity. And again, that gives us total liabilities and owner's equity. Okay. All right, so current assets, again, we've talked about current assets several times before. We've gotten practice with these before. Current assets are listed in the order of their convertibility to cash, or what is referred to as liquidity. Consist of cash and any other assets or resources that are expected to be realized in cash or to be sold or consumed during the normal operating cycle of the business. Following order is used to present accounts. So cash, notes receivable, and this would be short term because there are also long-term notes receivable, but if we were putting it in the current asset section, it would have to be a short-term notes receivable, accounts receivable, merchandise inventory. Short-term meaning 1 year or less, promissory notes or promise to pay. This is that note receivable account, generally received from a customer as a substitute for a charge account. And notes receivable, sometimes we say, is a more formal payment arrangement or payment agreement. Prepaid insurance and supplies are both considered prepaid items that will be used or will expire with the following operating cycle or year. They're not converted to cash. They're just used up as we go. So they appear at the bottom of the current asset section. Property and equipment, again, these are long-lived or fixed assets that are held for use in production or sale of other assets or services. Accountants refer to them also or oftentimes as fixed assets, plant assets, or PPE, which means property, plant, and equipment. Three accounts that appear in this category are land, building, and equipment. Just like it shows here, building and equipment accounts are followed by their respective accumulated depreciation accounts. Property and equipment assets are listed in the order of their length of life, with the longest lived asset placed first. And remember, land is not depreciable. So we do not have an accumulated depreciation account for land. Okay, current liabilities, debts that will become due within the normal operating cycle of the business, usually within 1 year, normally paid from current assets when they are due. Accounts that are that usually appear in this category, notes payable, mortgage payable, accounts payable. With a mortgage, I mean, generally speaking, a mortgage is a long-term liability, or a non-current liability, but in the current liability section, we would just list the current portion due. Current portion due within 1 year. Anything above and beyond that would be listed in the long-term liabilities section. Current liabilities are listed in the order of their expected payment. Long-term liabilities, debts that are payable over a comparatively long period, usually longer than 1 year. Current portion of notes, contracts, and loans is shown as a current liability. Remaining amount is shown as a long-term liability. Ratio analysis. So one thing, and I forgot for some reason, it wasn't in the PowerPoint slides. I'm not sure how it got missed, but another one. So they talk about working capital, just like it shows here. Working capital is the difference between current assets and current liabilities. So, you know, again, we expect to pay off current liabilities with our current assets. So essentially, this tells us kind of the amount of capital or the amount of money we have to work with once our current liabilities are paid off out of our current assets, right? So the amount of capital that a firm has to use or to work with during a normal operating cycle, which is normally less than 1 year, working capital, right? The one that I forgot to put in here is the gross profit percentage. This is another one that's looked at a lot. Gross profit percentage. And the formula for this is gross profit divided by net sales. And so, for example, just to make the math easy on me, if we've got gross profit of 10,000 and net sales were 20,000, right? Then we've got a gross profit percentage of 50% type deal. That's another one. Gross profit, it talks about this in our book, page 527. It says an important function of accounting is to provide tools for interpreting the financial statements or the results of operations. One ratio that is frequently used to analyze financial statements is gross profit percentage. The gross profit percentage, just, you know, kind of as we looked at in this example, is the percentage of our net sales that we have to contribute to operating expenses, and then to eventually, hopefully, earn a net profit, right? The current ratio is determined by dividing current assets by current liabilities, and they're showing us here. Useful in revealing a firm's ability to pay bills. So what this means, this current ratio here, is that for every $1 of liabilities, of current liabilities, we have $2.85 of current assets. So we almost have 3 times as much current assets as we have current liabilities, basically, right? for every $1 of liabilities. Because really, if we think about the standard ratio format, 2.85 to 1, right? So what this means, again, for every $1 of liabilities, we have $2.85 of current assets. Okay, finally, closing entries. The last step, or last couple steps rather, of the accounting cycle. Remember, closing entries are step 8, and then we do the post-closing trial balance, step 9. So just like we've learned before, at the end of the fiscal period, close all temporary equity accounts or nominal accounts. Close the revenue and expense accounts so that they can start the next fiscal period with 0 balances. Close the drawing account because it also applies to 1 fiscal period. And so remember, this is our first closing entry to close out all the revenue accounts. This is our second closing entry to close out all the expense accounts. The drawing account, that's our 4th closing entry. Remember, the 3rd is to transfer income to owner capital account, if we remember that from chapter 5. I know it was a whole semester ago, but to transfer income to the owner capital account. Okay, so step 1, so remember, and I just put this on the last slide. So remember, step 1 is to close out all the revenue accounts, but now also it includes any other accounts that appear on the income statement and that have credit balances, right? So this would also include not only sales revenue, but interest income. Purchase returns and allowances also have a credit balance. Purchase discounts also have a credit balance. And then course fees income also has a credit balance, right? So we add all of these up, and that's what we, right? We debit each of those to close them out, to zero them out. We credit income summary. Step 2, close all the expense account, but now we're expanding on that a little bit, and we're going to say, and the other accounts appearing in the income statement that have debit balances, right? So we list all these accounts that have normal debit balances. To close them out, to zero them out, we're going to credit them. So sales returns and allowances, sales discounts, purchases, freight in, and then all of these other expenses. And then whatever that amounts to is what we're going to debit to income summary. Now, step 3, we're going to transfer net income to the owner's capital account. So step 3, it says close the income summary account to the capital account, transferring the net income or loss to the capital account. So here was our inventory adjusting entry, the debit to income summary for the beginning merchandise inventory. Here was the credit to income summary for the ending merchandise inventory. Here was the entry for closing out all of our expense accounts. Here was the entry for closing out all of our revenue accounts. The difference is 105,851 is our net income. And so that's what we're transferring to owner's capital, right? 105,851. And again, here's that closing entry: debit, income summary, credit, owner's capital. All right, step 4, close out the drawing account. Again, whatever's in the drawing account, it has a normal debit balance. So to close it out, we're going to credit it. Capital has a normal credit balance. And so when we are recording or doing the closing entries for the drawing account, we debit owner capital, right? So that's our entry: debit owner capital, which reduces owner capital, credit owner drawing, which zeroes that drawing account out. Okay, finally, reversing entries. You know, again, we said this is step 10 of the accounting cycle, which, as it says on our accounting cycle, is an optional step. General journal entries that are the exact reverse of certain adjusting entries enables the accountant to record routine transactions in the usual manner, even though an adjusting entry affecting one of the accounts involved in the transaction has intervened. So the example they give us of this in the book is like, you know, if December 31st falls on a Wednesday, we have to accrue some of that liability. And so we've done this adjusting entry together before. Remember, this would be like, for example, a debit to wage expense, a credit to wages payable type deal would be the adjusting entry that we would do, you know, December 31 to record the expense. But then when we get into the next calendar year, 1/1, I guess that'd be 22, we would do the opposite. We would reverse this out. So let's say we debited wage expense for 1,000, we credited wages payable for 1,000. We would just flip flop it. We do the opposite. So the reversing entry would be a debit to wages payable for 1,000, a credit to wage expense for 1,000. So reversing entry is just the exact opposite of the initial adjusting entry. Conditions for reversing entries. If an adjusting entry is to be reversed, it must meet both of the following qualifications. So number one, adjusting entry increases an asset or liability account. Asset or liability account did not have a previous balance. So just like it shows here, with the exception of the first year of operations, merchandise inventory and contra accounts like accumulated depreciation always have previous balances. Consequently, adjusting entries involving these accounts should never be reversed. So whenever it has a previous balance, if it has a previous balance, do not reverse. All right, here are some of the practice exercises that I have that we're going to go through in class together. And hopefully this was helpful to you guys. Hi there, everybody. And as always, once you have a chance to view this recorded lecture, read the chapter, please let me know if you have any questions. Shoot me an email or see me in class, and I will see you guys soon. Bye-bye.